In the case of gold, China has more or less cornered the gold market. I put out a note today analyzing how much gold China actually has, China and her citizens. China has something like 75,500 tons. The story in silver is obviously different, but China again has been a big player in silver as one of the leading global mining nations. Not only that, but over a long period of time, they've been importing silver doré, refining it, hanging on to silver, but using their clout to keep the price suppressed. That's no longer happening. So we've got shortages developing in silver now, too, as far as Western capital markets are concerned.
Gold and silver markets are undergoing a historic transformation, mainly driven by China's aggressive accumulation and control. In the case of gold, China and its citizens now hold roughly 75,500 tons, representing more than a third of all above-ground stock. This accumulation, ongoing since the early 1980s, has left Western investors and central banks significantly exposed. Meanwhile, silver is experiencing a similar shift. As one of the leading global mining nations, China has long imported, refined, and hoarded silver, actively suppressing prices. That dynamic is changing, and shortages are emerging in Western markets, creating a squeeze on traders and managed funds who remain short. Alasdair Macleod, a respected authority on precious metals and monetary systems, explains that these developments signal more than market fluctuations. They reflect the weakening foundations of the fiat currency system itself. According to him, as currencies lose purchasing power, investors are likely to pivot heavily toward tangible assets like gold and silver, driving prices dramatically higher. The concentration of physical metals in China and the structural short positions in Western markets could trigger a systemic crisis, making the next few years critical for wealth preservation. Now, we present the clips from Alasdair Macleod's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates, and enjoy the video.
In the case of gold, China has more or less cornered the gold market. I put out a note today analyzing how much gold China actually has, China and her citizens. And, if you want to read it, you can pick it up on my Substack. I reckon, and I'm fairly confident of these figures, that China has something like 75,500 tons between it and its citizens. Bear in mind that it's been accumulating this since 1983. So we're talking about over a long period of time. Also in a big bear market between 1983 and 2002. And it was at a time when we were selling gold hugely. I mean, we were selling not only our gold as an investors, but also the central banks were selling gold. And not only were they selling gold, but people were taking delivery of gold, leased gold, and selling it into the market and putting the funds into US treasuries. And the gold disappeared. Guess who was buying it? China. I mean, the point is that if you look at the above ground stocks of around about 200,000 tons, look at how much gold China has got. We're looking at 36% of all above ground stock. It's leaving everybody else short. It's a short answer. And so we're seeing the squeeze now. And, the major US banks, amongst others, are beginning to get bullish on gold. And they manage portfolios which have no gold. And, at the moment, while, the Magnificent Seven are soaring and, credit bubble is intact, perhaps underlying investors don't care too much. But when that pops and they've got no gold, they'll be looking at a very, very different situation. And I think that these banks are beginning to realize that they've got to have some gold. But if you look at just adding to the 0.5%, which global portfolios own of physical gold, if you take that up by 1%, they've got to find 25,000 tons at current prices. It's not there. It is not there. And this buying is going to happen. Of that, there is absolutely no doubt whatsoever. So what we're seeing at the moment, which might be terribly exciting for the bulls, gold rushing up to 3,900 and, looking as people forecasting it's going to go 4,300 or whatever. That's just the start of it. This is actually, I think, a crisis developing within the precious metals market. And what we see in gold, we're also seeing in silver. The story in silver is obviously different, but China again has been a big player in silver as one of the leading global mining nations. Not only that, but over a long period of time, they've been importing silver doré, refining it, hanging on to silver, but using their clout to keep the price suppressed. That's no longer happening. So we've got shortages developing in silver now, too, as far as Western capital markets are concerned. I mean, the fact is that, pricing of these things is no longer under our control. It's all gone on to Shanghai. What we're seeing is the squeeze on the establishment, the people who are short, not just establishment. I mean, if you look at the commitment of traders figures, you'll find that even managed funds have short positions. I mean, they're net long, but they've still got some short positions. The swaps, obviously, a big net short. The liabilities that are mounting up on the shorts are just staggering, absolutely staggering. And I think actually what we're looking at, if you stand back, we're looking at the dying days of the fiat currency system. And, that basically means that after a period of time, it doesn't matter don't know how long it'll be, but I suspect it won't be all that long. Unless governments actually manage to pin their currencies to gold, they'll become valueless. They'll go down to close to zero. I really can't see the politicians even thinking that they need to protect their currencies. They're still spendthrifts. They're still, having huge, great deficits on their budgets. They don't care. They just complain that the markets need higher interest rates. Well, it's hardly surprising. You're going to need higher interest rates still. And meanwhile, everybody in the market, in this credit bubble, assumes that inflation is going to diminish. But I mean, the thing they get wrong is it's not, sort of prices, if you like, in that sense. It's the loss of purchasing power of the currency. That's what they've got to look out for. And if I'm right that we are in the dying days of the fiat currency system, then prices are going to soar in the next 2 years. And that is something which, of course, nobody expects. But it won't be prices going up. It'll be the value of currencies going down, their purchasing power collapsing. And of course, as soon as people realize that, they dump the currency for anything they can get with it. I think that's the future. I think we have to, if you like, divide out bullion banks from others in the market, as it were. I mean, bullion banks will try and run a balanced position as much as possible. Where they're short on COMEX, they're probably long in London, sort of thing. But when you've got hedge funds, when you've got people, and maybe market makers just making a market in the swaps rather than having positions in London as well, then they could become, if you like, a systemic problem, which I think they try and cover up. They must try and cover it up. I think it's not impossible that a bullion bank will get into difficulties, but I think it's more likely it's amongst their clients that the difficulties will arise. That would be my view anyway. Well, within the COMEX rules, they can declare force majeure, but nobody's going to want to see that at all. I think what's likely to happen is there will be a rescue behind the scenes. We won't know about it. It'll be hushed up. It'll be very, very quiet, but it will happen. And it wouldn't surprise me if that happens quite soon. But, we're not to know about it, because if you get a failure in these markets, particularly gold and silver, this could undermine the whole of the derivative industry. I mean, because we're not just talking about, those derivatives. I mean, they are central to everything. Just think about the Exeter pyramid with gold at the bottom supporting everything else. And if you get a failure in what is actually legally money and all else is credit, the failure in real money counterparties, then, this is serious. You've got to bear in mind that the market has moved. It's now over in Shanghai. I mean, the physical market's over there, not over here.
Gold continues to lead the charge in commodities, setting the pace for other markets, particularly base metals and energy. Relative to gold, many commodities are now historically cheap, creating a growing strain on traditional market relationships. As credit bubbles remain inflated, the potential for a significant market correction looms large. Leverage levels in financial markets have reached record highs, with positions now magnitudes larger than a decade ago. When a correction occurs, these leveraged positions are likely to unwind rapidly, triggering cascading effects across global markets. This environment is expected to drive a significant rotation from paper assets into physical bullion. Investment managers and institutional portfolios, many of which currently hold little to no gold, will face immense pressure to secure safe haven assets as equity and tech markets decline. However, physical gold supply is minimal, with much of the market concentrated elsewhere. This scarcity, combined with growing institutional demand, could push bullion prices dramatically higher. COMEX deliveries and ETF growth indicate an early stage of this transition, but the strain on global supply chains is just beginning to manifest. Market dynamics are entering a phase where physical metals could become the central pillar of wealth preservation, highlighting the vulnerabilities in conventional financial instruments. Let's get back to the interview.
Gold is leading the way upwards in commodities. And my view is that it's likely to drag other commodities like base metals, for example, and energy up with it, but particularly base metals. I mean, they are, relative to gold, they are now cheaper than they have ever been. And since gold is the real money standard, as it were, even though that's being driven up, if you like, by markets, I would see that all these relationships are going to come under huge, huge strain. And it's not good for the purchasing power of paper currencies. Well, I think there's an increasing likelihood that the credit bubble will burst, come to an end. Now, if that happens, it's going to unleash, I think, some major developments in the markets. I mean, apart from anything else, something like a 1987 style crash or a 1929, October 1929, both October, incidentally. This is quite a dangerous time historically. That style, that sort of scale of move down is going to create huge, huge, great problems because the amount of leverage in the market is at record levels. I mean, just look at the figures coming out of FINRA. I mean, the end of August, the level of leverage was about 1.2 trillion, I think, from memory. And that's up 4 or 5 times since over the last 10 years. This is huge leverage in the market. That gets unwound very, very quickly. And you find that, if the market drops 25%, say, when it starts, then, a lot of these leverage positions and the experience of a deflating bubble, particularly when you've got the complexity of tariffs put on top of it, trade tariffs and all the rest of it. I mean, it's just like 1929, and this is not good. But this time it's even bigger. It's bigger than 29. I mean, a lot bigger. So whether it happens in the next month or two, I don't know. I think it's quite likely to happen by the year end. And then, of course, that's going to have a huge, great impact on bullion. Because if you think about it, I mean, every market's going to be in the same position. Some people will have, think they got wonderful profits in bullion and they'll cover the losses by selling bullion. But apart from that short-term effect, what we're likely to see is a flight out of paper into physical bullion. I mean, just get the hell out of paper. It'll start in the financial markets, that move. So it would drive, and think of it from the point of view of a large investment management organization with their clients holding no gold at all, which is par for the course, long up to their necks in tech stocks and whatever. When that starts collapsing, where do they go? I mean, the answer is they try and get out of the falling stocks as quickly as possible and anything where they can sort of rescue something. But on the margin, they're going to be saying, well, the one thing we haven't got is bullion. We've got to get into safety. And I think that's what the foreigners will do, probably more, initially anyway, more than domestic institutions. The problem is, Danny, that there just is not the bullion there to satisfy the potential demand coming out of institutions. And we should note that analysts at the big banks are now forecasting higher gold prices, but their investment managers haven't got any. So what do? I mean, where do they go? If you look at how much gold is really required to satisfy just 1% of portfolio allocation across the world, you're looking at 25,000 tons of gold at current prices. Now that is just not there because China's cornered the market. And nobody else wants to let it go either. I mean, okay, a few traders and so on who will let it go. But, if we're talking about physical, we're not talking about paper. If we're talking about physical, it's just not there. And the paper market, what does the paper market do? I mean, basically, what we can see is a likely major move into metals because they are performing, gold and silver anyway. And because it's not there, prices go through the roof, crisis ensues. So I think this is the danger. I mean, I think it would be dangerous, I think, for me to forecast this as such. So I don't come out with forecasts, but I just look at the dangers, if you like, that are likely. And this to me is the big danger at the moment. Nobody's got gold. Nobody's got physical gold in the West. They're running an awful lot of portfolio money. And at some stage, they're going to try and move over. And when you've got, people like Goldman Sachs saying we expect gold to go to 4,000, whatever, by the end of. I mean, I don't know whether they're talking any sense at all. Probably not. They're probably just looking at the charts. But you can see how, this actually leaves the investment managers who got none in a bit of a pickle. What do they do about it? And the gold isn't there. They can't get it. I mean, you've got parties who we don't know who they are, who are standing for delivery on COMEX as the only way in which they can get any physical. And so far this year, I mean, I reckon it's about 950 tons has been stood for delivery on COMEX this year alone. By the end of this year, it's going to be well over 1,000 tons, probably closer to 1,500, I think, the way things are going. There was a very big delivery yesterday, 66 tons or something, and silver also. COMEX wasn't meant to be for this at all. But people are using it as a means of getting bullion which they can't get elsewhere. I think the ETFs are growing in size, but I think it's only just started. People they haven't realized that gold is, in their terms, in a bull market. In my terms, the currency is actually in a bear market, which is actually far more serious. They haven't really understood it yet, but they're sort of gradually waking up to the fact that, they don't really know why, but they really should have some gold. It's the only game in town. So, they will go, I mean, and the same with SLV. I mean, it's going to put huge strains on the combination of COMEX and London, that's for sure, because it's just not there. So where does the manager of GLD go for it? It's going to be interesting.
Gold's momentum continues to reshape commodity markets, with its rise increasingly influencing base metals and energy. These markets, relative to gold, remain undervalued, creating mounting pressure on traditional pricing structures. The leverage embedded in global financial markets has reached unprecedented levels, and any unwinding is likely to trigger sharp, cascading corrections. Institutional portfolios with minimal exposure to bullion will confront a pressing need for safety. Physical gold and silver are in short supply, with much of the supply concentrated in Asia, leaving Western markets short and vulnerable. The shift from paper assets to physical metals is accelerating. ETFs and COMEX deliveries illustrate early signs of this migration. Investors and managers seeking tangible security will find the gap between demand and supply widening, intensifying upward pressure on prices. This transition reflects a broader structural change, where tangible assets increasingly supplant fiat-based instruments, exposing the fragility of conventional portfolios. As market dynamics evolve, positioning in physical metals is becoming not just strategic, but essential. Those who recognize the shift early will be best prepared for the challenges ahead, safeguarding wealth in a period of heightened volatility and systemic risk. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.